Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening. I'm Michael Hartzman, along as always with Dominick Tavella. And today is Tuesday, August 17th, 2021. Good evening, Dom. How are you?
Good evening, Mike. How are you?
I'm well, thank you. So today the market was a little ugly. It was down 300 points, but 300 points just ain't what it used to be, Dom. That's 0.75%. It wasn't even a 1% drop.
It looked like it might be worse. It looked like during the day it might turn really ugly, and maybe that'll be tomorrow or the balance of this week. But at least for today, it was kind of muted, recovered a little bit late in the afternoon. But it really has us starting to think that we might finally be seeing the beginnings of some kind of a little bit of a pullback in the markets.
We could. August is traditionally a little sloppy in the market. People are away. There's not much volume. It doesn't really take much for the market to turn over. So you could be right. But to your point, you mentioned earlier this morning on our morning call with our advisors, an interesting stat that the market has not been down 5% or more in over 200 days, which is a long time for the market not to have at least a modest sell-off.
Yeah, it really is a little unusual, Mike. And for us to call for a 5 or 10% pullback is not much of a stretch on our part or deep insight, because on the average, the market has a little bit of a pullback, 5-10%, about every 100 days, a little bit over every 3 months or so. Not on clockwork, but that's the average. So these things tend to be normal and routine, and we try to warn clients that they're going to happen, they might happen. But we've gone a really long time now without a respectable pullback. And for good reason, the markets have been behaving themselves, earnings, and we've talked about it on past podcast, but this time we have some noise, and maybe it's for real.
It could be. And the other thing we say every week, this has kind of been a stealthy market. I mean, the market before today was up. The S&P was up over 20%. The Dow was up over 17, and the NASDAQ was up 15. So if the year ended today, everyone would go home happy. These are still great numbers.
And I think most professionals would be very happy to end it today. It's funny because yesterday we had two Wall Street titans, one talking about a 10-15% correction, and the markets being substantially lower than where they are today on December 31st. And the other one, or both shall remain nameless, but the other one was talking about the market was going to close substantially higher than where we are today, and it was going to be a rising tide that was going to lift all boats. We're just kind of caught in the middle trying to make decisions on a daily basis, but we'll see what happens.
Yeah, and every time we hear that, it just continues to reiterate our argument to stay diversified.
Look, I always find it ironic, but maybe clients don't. The things that worked yesterday don't work today. The things that didn't work yesterday are now working. And we can take that argument into this year. We had a really strong value play. The boring conservative stocks that reopening the economy worked really well, and growth did not. And now that's flipped on its head. So we're looking for an interesting end of the year, and we're trying to position ourselves to ride out the storm.
And the other headline that has kind of gone away in our short attention span media is the 10-year Treasury is 1.29. And I'm old enough to remember when it was 1.75 in the springtime, and people were
that was only 6 months ago, Mike. So
exactly.
No memory lapses there. You're spot on. Thanks.
So, tomorrow we will see what the market will bring us. But let's talk about tonight's show. We have three special guests. We have William and Sarah Lieberman on our first segment that you and I are going to talk to. William is the founder and partner of the CEO's right hand. And then his wife, Sarah, is a HR consultant. They're both friends of the show and friends of ours. And then Jordan Kimmel is going to be on tonight with Liz Claman from Fox Business News. So we're going to touch a lot of bases tonight. I'm looking forward to getting started.
Yeah, look, we obviously are going to talk about the markets. We're obviously going to talk about what's going on in the economy. But some of our more interesting podcasts, when we bring guests that are a little bit out of that mainstream discussion that we have and bring subjects to light. And I think our first two guests are really prime examples of that. So I'm looking forward to that conversation.
Yeah, absolutely. You know, most employees just take benefits for granted. You know, when they look at a job, they just want to know what the salary is and if there's a 401k. And it's just a deeper dive. There's so many more benefits available, especially now. And then with the pandemic really changing the landscape of how people work. And William is an expert in that area, having started his business from home 6 years ago. I think they're going to bring a unique perspective.
Look, we've mentioned it many times. The employer relationship is really changing because of COVID. The way people work, the way they function, the way they commute is really changing. And clearly employers have had a difficult time recruiting new employees and getting the old ones to come back to work. So I think we have two people that really can hopefully shine a little light onto what's going on and maybe what some of the solutions might be.
I hope so. So on that note, we will be right back with William and Sarah Lieberman. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the fund is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
for
taxes.
your cash.
More income.
Ask your advisor about the Lebenthal Ultra Short Tax-Free Income Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn,
it's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
And I'm Michael Hartzman, back with Dominick, Tavella, and William and Sarah Lieberman. Hey guys, how are you?
Good. How are you?
Great to be here.
Welcome.
So Sarah, I'm going to start with you this evening. Just give us a quick overview on how the benefits landscape has changed over the last few years with both millennials coming into the workforce and having a different expectation of the work environment, and then combine that with the last year and a half with this whole work from home phenomenon. So could you give us kind of a brief overview?
Yeah. Well, I think over the last few years, people have been looking at their benefits probably in a more holistic fashion and really have been focused on what their individual needs may be, aside from just, your typical medical, dental, vision, sort of life insurance, AD&D, STD, and LTD, which is sort of the offering that employers typically provide to employees. Now employees are really looking at what can my employer help me with in terms of my, sort of day-to-day life. If I'm a millennial that's thinking about starting a family, I may be looking at fertility benefits and family planning, and I'm going to be looking for my employer to provide me with those options. If I am somebody who is interested in transgender, I may be looking to my employer to provide me with that level of benefit through the health plan. Benefits is increasingly a complex landscape, and helping employees navigate that in terms of their claims, in terms of what's covered. So additional education as well as health advocacy has become a lot more important. And probably lastly, because of COVID and because there's so much stress associated with the last couple of years, individuals are really looking for just wellness in general, things that are going to help them reduce stress, things like meditation, things like additional mental health benefits. Those things are becoming increasingly more important. And if one thing, COVID has shown us, and sort of being in lockdown, individuals who still need access to healthcare, telemedicine has really been something that has been on the rise more and more. The concept that you can sort of call up your doctor and via Zoom or via some other telephonic way to connect and get the results you need quickly without necessarily going someplace. Or if you need to see a provider quickly and you are in back-to-back meetings, as so many of us are, providers that are able to connect you with doctors quickly, schedule those kinds of things for you, like a health concierge. Those types of services have also been in the forefront in the past couple of years.
And I think, when I see my clients and looking at what employers have to do to attract and retain talent, it's less important for employer to have cafeteria, literally free food, and a bocce ball court on campus. And it's more important to have the flexibility working from home or hybrid that makes sense for their employees. Employers have to be much more flexible in those types of benefits, the softer benefits that they provide to their employees, given the vast competition for talent that the pandemic has now, brought to the fore even more than it was before.
Yeah, another thing when we think of millennials in particular, who are sort of taking a long view of their health and a long view of their life and tax implications and finances, high deductible plans with an HSA where employers could, make a contribution into their health savings account over time really creates that tax benefit and allows certainly, younger families to take advantage of tax savings and take a longer view of how they become consumers of medical and health benefits.
So probably one of the hottest topics today, and we're hearing it both from the employers who are trying to get their employees to come back to a real office environment, and employees who are saying, hey, if you're going to make me go back to the office, I'm not going back. I'll just find another job. How much of this are you guys dealing with on a daily basis, and what is really going to be the solution here?
Yeah, I think all of us are dealing with that on a daily basis as employees, as employers, or, just as people, right? And the one thing that I'm very, very aware of as I speak to individuals on this topic is it changes daily. It changes daily based on someone's comfort level of being in the office or being in public transportation or or not being in the office. But I think it's something that's going to be with us for a while. I think this is the new normal, right? And I think this hybrid work environment or a flexible work environment is here to stay. I don't believe that, working 100% from home is going to be the future, but nor do I believe that working solely 100% in the office is going to be the norm either. I think employers and employees have to be flexible and should be flexible, certainly in the short term, if not the long term. I think employees are looking for the flexibility. Interestingly enough, there have been numerous polls done over the course of the last year, and most employees do not want to solely work from home. They do want to come back to the office, but they want to come back into the office in a flexible manner. Maybe they want to work from the office 3 days a week and be home 2 days a week, or 4 days a week and 1 day a week, but they want that flexibility. And I think from an employer perspective, it's going to be challenging how to provide a safe, comfortable environment, certainly in the short term for everyone, because this topic is still sort of fraught with anxiety for many people. And so vaccinations and testing and wearing masks and all of that, I think, is going to be here to stay for a while for all of us.
William, when you founded the CEO's Right Hand with your partner 6 years ago, you were a bit of an outlier working from home. Did you have a hard time recruiting people as employees or convincing them to work from home? And now with your own client base, how has your experience changed versus today when you have a client and we're all working from home in some shape, way, or form?
Well, in the beginning, because I had always been this company, I'd always wanted to have a virtual company. I didn't want to have the large overhead that office space, especially in Manhattan, it's expensive space, and the commute for myself, my staff. It was a burden for everybody back, 6+ years ago. So I always wanted to have a ability to be flexible for the staff. And I think that has enabled me to get people that I wouldn't otherwise. I mean, I have staff in San Francisco and Denver and Florida and Texas and everywhere in between. So I, for years and years, have been able to go get the best talent for myself and for my client base. And that's been a big advantage for me. And now, the competition for talent is even more intense. So I've been able to continue to leverage my experience set for the many years. In terms of the clients, even when I had clients in Manhattan and I'm 35-minute train ride away, I was doing Skype calls, and this before Zoom was a big thing. So I was doing Skype calls with clients every week and on management team calls, et cetera. And they were comfortable with it. And I got very comfortable with it very quickly. And they liked the flexibility. They liked the ability to say, hey, I'm not quite ready for this meeting. Can I chat you in half an hour? Whatever it might be. It allowed them to be more flexible, me to be more flexible, and my staff that I could draw upon. So now instead of saying, hey, I have to have somebody with this particular expertise who's 60 minutes away from New York City, I could have somebody with that expertise in Boise, Idaho, or Denver, Colorado. And it really has provided me the ability to grow and scale much more quickly than I would otherwise.
So, William, you hit on a key word there, comfortable. And just what we're doing right now, I think both employers and employees and clients are getting more comfortable being able to do a Zoom call or a Skype call. But we're starting to hear employers going, oh, well, I'm not paying for office space, and I'm not going to pay for phone systems, and I'm not going to pay you the compensation I was paying you to come in an office. So how much of this is really going to be a point of conflict down the road, where employers are like, I'm just not going to pay you the kind of money I was paying you if you're working either remotely or working out of a location that is a substantially lower cost environment than, say, Manhattan is.
Right. And Sarah and I have talked about this sort of cost of living adjustment across the country, and whether or not that makes sense or not. I think in today's pandemic world, people and employees have much more choice than they did otherwise. So if an employer doesn't provide the proper market rate compensation for an employee, it's very easy for that employee to walk out the door virtually and go find another position with somebody who is willing to pay. And you see that across, especially in tech and business services, e-commerce, the green businesses, the high-flying sort of stock or businesses, industries of the day. They're very competitive, and market rates for knowledge workers in those types of businesses are skyrocketing. Cybersecurity is a great example. So you have to be, as an employer, very willing and able to pay somebody's market rate, whether or not they live in Boise or whether or not they live in New York City.
So there will always be differences between somebody who works in Boise and someone who works in New York City, but I'm not sure that compensation is going to be specifically impacted because that individual works from home or works in the office.
So you guys made a comment before, we talked briefly about the millennials, and William, you said jokingly that bocce ball court is not as important as it used to be. And I mean, is that really true? Because I still get the impression that millennials want that open concept. Sarah, you mentioned meditation and maybe, there's yoga businesses with yoga studios, no walls. So how much of that is really important, and how much of that was really a fad?
Well, I think, when my comment was specifically around Google's campus, and they spent an ungodly amount of money to building out the campus and building out the facilities, the benefits, the fringe benefits, the coffee machines, and all of the types of extra additional benefits that Silicon Valley workers expected and needed to see, especially in high tech. So today, we're seeing more and more of those employees, instead of demanding an espresso machine, they're demanding flexibility, as Sarah's talked about, flexibility in terms of working from home on specific days or a certain amount of time. I think that's more important than having the espresso machine in the office. And I use bocce ball as a different example. But that was my point, is that flexibility of work-life balance is more important than having all the fancy accoutrement of a campus.
Well, I will say that using Google as an example, through the pandemic, they have put a lot of money and thought into building out outdoor conference rooms and outdoor spaces where individuals can still be together, still be on campus, but be safe because they are socially distancing and are outside. Right. So I think the moral of the story, if you will, is it's not a one size fits all. It really is being thoughtful around what is your culture, what are your business requirements, and how can you safely bring back your employees, if that's what you want to do, into an environment where they will feel comfortable and they will feel authentic and they will want to come back to and feel safe, essentially. So because whether somebody wants to work from home, that's not always possible. And the flip side of what's been going on is it is progressively more difficult for a business to build culture when everybody's co-located. It's very difficult to do that. Training becomes more difficult. There's a lot of aspects when folks are not together it provides challenges to the environment. So I think the name of the game here is, how can we be more thoughtful and how can we be more flexible in the culture that we want to create and in the work that we want to do?
So do you think this...
And as an employer, how do we make our employees more productive, right? And to working from home, one could say, well, they're more productive. In some cases, maybe not so, right? So it's, as you say, it's not black and white. It is absolutely not black and white.
So we could joke about, how literally it used to be if the company had a 401k plan and what were the medical benefits. And today, and we did joke about the espresso machine. That was real priority for a lot of employees. But today, it really seems this holistic quality of life argument is just forefront, right? The other issues are kind of important, but maybe it's the COVID, maybe it's we went through this deep crisis in the country and the world. But do you think it's going to last? Do you think this is a paradigm shift in the way people are thinking, or we'll eventually go back to that workaholic type environment, and it'll all go by the wayside?
I tend to think, and I'm no prophet, and I certainly don't have a crystal ball, but I tend to think that millennials as a group do want a lot more from their employers with respect to a work-life balance. I mean, and we've been watching it in terms of the gig economy, right? The gig economy is springing up, this concept that I'm going to work, a 9 to 5, or who are we kidding? A 9 to 9 day, 40 hours a week for a single employer for however long. Those days are long gone. People are thinking a lot more creatively around their employment prospects and how they build their careers and where they build their careers. And so I do think that there is going to be, to some degree, more of a paradigm shift as the younger generation sort of enter the workforce, because they do have a slightly different perspective on what it means to add value, that it's they're not on the clock. That's not how they see the world. And it's really all about, while I'm here and I'm present and I'm adding value, that's what I do. But then you, employer, have to be flexible with me and understand what I'm looking for from not just sort of the time that I'm with you, but my entire life, and whether that's helping me with childcare while I'm here, or helping me with, health concierge where there's a clinic downstairs that I can go to, or being flexible in where I work and how I work. I think those things are shifting somewhat.
William and Sarah, believe it or not, but we are out of time. This flew by.
Wow.
I can't thank you guys enough. And all I can say to you both is get home safe.
Commute's terrible, I gotta say.
I enjoyed the conversation. I look forward to continuing. I probably had about 36 more questions, Mike, for discussion, but we'll hopefully have you guys back. I'd love to continue the conversation. I think this whole world is evolving on this issue, and we're all adapting as we go. So we'd love to have your input going forward.
Love to.
Thank you, guys.
Thank you.
Jordan Kimmel, we'll be right back with Liz Claman.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel, Chief Equity Strategist and Portfolio Manager. And it is a delight to bring on an old friend, a good friend. It's Liz Claman, one of the most recognizable faces and voices in business on TV. Liz, thanks so much for joining us.
Oh my gosh, Jordan, thank you. I am so honored to be here. Thank you. Thank you.
Well, we're going to have some fun. We got plenty of time to really go through some things. And Liz, I appreciate your time. We know that not only are you the most recognized face on TV and probably everybody's favorite, but you're also doing Everybody Talks to Liz on your own podcast. Mm-hmm. And we can get into that for a while too. But I want to start with, look, we've both been in the business a couple of years. Let's not stretch it, okay? But the market's changed a lot. I want you to talk maybe the size, the scope, the 24-hour media, indexing, ETFs. These things really were minor several years ago. Tell me some of the things that you find kind of most interesting with how the business has changed.
Well, I'm going to envision that your listeners have been in the business for all different spans of time. You know, what I find so fascinating right now is this huge burgeoning group of retail investors. You can call them the meme stock or the Reddit room rebels, whatever you want. They're new. And then you've got the old school people from way back in the day who for decades have really understood and watched Wall Street and played it. And then you have people like me. You know, my dad was a surgeon. I grew up in California. My mom was a Shakespearean trained theater actress. Wow. We never talked about stocks. I mean, if ever there was a discussion, it was my dad saying, Kodak, kids, Kodak put you through college. You know, every morning he would run out to get the LA Times and he'd take his finger and he'd go down the stock charts, remember, back in the business section, and he'd look and he'd say, oh, it was down a 16th, right? It was in fractions back then.
Right.
And then he'd look at me and he'd say, yeah, but you know what? The big boys on Wall Street in New York City already know from yesterday what happened. So it's not really fair. What a difference the time has made and the democratization of investing that we've seen right now. And people who really kind of have just started playing the markets have no idea what a gift they have, that they get this real-time information. So I really kind of became aware in 1998 when I was covering, you know, a whale carcass off the coast of Rhode Island because I came from local news, and I was in Boston, and I got a call saying CNBC wants to meet you. They like how you are on TV, and they're thinking they want some people who are really kind of easy to relate to on television. They think they can teach you business. And I remember sitting down in my apartment in Cambridge, Massachusetts, and tuning in. I was working at the NBC station in Boston at the time, WHDH, and I looked and I turned to CNBC. Again, this is 1998, and I'm looking at the ticker, and it's like, why is it going off the screen? What is that? What are all those letters and numbers? I mean, when I say I had zero clue, I had zero clue. So I'm really living proof that if you dive in and you study and you really make it part of your life, you can absolutely learn and get up to speed. But I really had no idea what I was talking about. And thank God CNBC, the guy named Bruno Cohen who hired me was like, don't worry, we'll teach you. We just like how you communicate on TV. We have people who understand business, but they're terrible communicators. So they brought me in and I set about learning, and I've never stopped learning. And that was, again, 23 years ago. And I will say the learning curve was vertical, but back then, and Jordan, you know this, the ticker was rudimentary. It was 20 minutes delayed on TV, and we didn't have 1/10 of what we have now, 1/100th of what we have now. Right. We have instant information, whether it's derivatives or commodities or, you know, the yield, anything that you want on the bond curve. And it's just amazing. I feel like I've watched history being made.
Well, you know, Liz, I remember back in that 98 period where I would come on CNBC and you were a prolific learner. And you said, can you stay behind and let's talk a little bit? And now I want to mention, you know, where you came is that not only do we love Liz Claman and the rest of TV love it, but two of the most influential, smartest, brilliant investors of our era took a shining to you. And a Warren Buffett's Buffett stock, no one got closer to Buffett than you did over many years. And I want you to kind of share kind of the privilege of being really next to Buffett and Charlie Munger, and maybe some lessons you learned or some of the fun you've had over those years with them.
I think part of the reason maybe that Warren Buffett did take a liking to me, as you say, is because, okay, so I grew up in Beverly Hills, And I grew up, everybody's parents were famous, you know, I mean, Diana Ross's kid, and, you know, Smokey Robinson, all the studio chiefs. I went to school with their kids, and I'm not bragging. I'm just using that to explain that I never was impressed by what people did. It was who they were as human beings. That my dad, the surgeon who grew up poverty-stricken and became a world-renowned doctor, taught us. And he said, it doesn't matter who somebody thinks they are, it's who they truly are. And so when I got to CNBC, they kept talking about this goofy guy in Nebraska named Warren Buffett, who was a billionaire. Now in let's call it, actually, it was more like 2004. He was not who he is today. I always joke with him and I say, oh my God, Warren, I created a monster.
You made him, Liz.
Well, you know, because he really did not talk to reporters back then. And that's what everybody said. And one day my co-anchor at the time, Bob Sellers, said, oh, listen, this stock is going to jump up on the screen. It's Berkshire Hathaway, and it's going to say $60,000 a share. That's right. Not a typo. Because, you know, our charts would sometimes wig out and we get some error and some crazy price. And he said, it's not a typo. It's just that the stock has never split.
Right.
And the guy who runs the company is kind of quirky, and he lives in Nebraska, and he buys what are called value companies, and his name's Warren Buffett, and it's called Berkshire Hathaway. And I was like, okay, I'm bored already, whatever. And then he said, well, he owns Dairy Queen. I'm like, okay, yeah, I really like the blizzards and the breezes.
Starting to get somewhere.
Okay. Well, one day, in about 2004 or 5, we all got called in by the head of the network, and he said, you all have to land a really big name. I don't care who it is, just do it. So I thought, well, what about that guy out in Nebraska? So I picked up the phone and I called Berkshire Hathaway in Omaha, and Mr. Buffett's office, you know, it was like Berkshire Hathaway. You know, I'm thinking, this is like out of an old Broadway show, you know, How to Succeed in Business Without Really Trying or something. And I said, yeah, I need to talk to Warren Buffett. Well, who is this? I said, Liz Claman from CNBC. I was doing the 10 a.m. at the time, 5 to 7 a.m. and 10 a.m. You remember, Jordan, you were always on that show.
I was with you. Yep.
And he said, and the secretary said, he doesn't speak to reporters. So I just remained silent, because that was always my trick in local news. Somebody said no, I would just kind of sit there and let them stew in their rejection of me. And more often than not, they'd kind of think about it. There would be this awkward silence. And there was. And she said, well, he is a fan of yours. And I was like, what? She said, hold on. Boom. He answers the phone and says, hi, Liz, I just finished watching you. And I said, oh, yeah, how'd I do? Because again, I really didn't look at anybody as special. I look at everybody as, well, show me what you're made of. And I said, well, listen, I'd really love to come and talk to you about the markets. I don't know what the markets are going to do. I said, well, you know, we've got the midterm elections coming up. I don't know what's happening in politics. So now I'm really striking out. Here I thought I was in. And he's saying, yeah, I don't know anything about that. I don't know anything about that. And then I thought, wait a minute, what did Bob tell me? My co-anchor had said he's into value investing. So I said, how about I come to Nebraska and see how you value a company? And he said, well, tell me about yourself. And I remembered Bob also telling me he's really down to earth, which, hello. So I said, oh, I'm really down to earth. And he said, yeah, where are you from? Now I'm like, oh God. I said, Beverly Hills, with an explanation. And he said, what's the explanation? And I said, both my parents were sons and daughters of penniless immigrants from Romania and Russia, Jewish, and they worked their way up to success, never took a dime from governments. They just worked really hard and became what they are today. And he said, I bought 2 of my best businesses from Russian Jewish immigrants who came to this country penniless. And I'm thinking, finally, it's good to be Jewish. Finally, somebody doesn't hate me for being Jewish. So that was the beginning of our relationship. And he just
adored
liked
you.
The fact that I listened.
Right.
And that's how it all came to be. So I went to Nebraska and I thought we might get 20 minutes with him. He spent the whole day with us, and we turned it into an hour-long special called The Billionaire Next Door. and it ran multiple times, and it was the most successful, highest rated hour-long documentary CNBC had ever done until that point. And then, of course, David Faber, my good friend, ended up doing the one on Walmart, which was really big too. But people had never seen Buffett unplugged like this.
Right.
And that's
well, Liz, it's your ability to do it. And you know what I want to do here too? I want to mention something that you brought up earlier about the retail investor coming back.
Mm-hmm.
We're seeing it on TV now. I want to mention, as the producer is going to bring on another old friend of yours, by the way, we're going to bring on Dom and Mike right now to kind of ask some more things.
Oh my gosh.
But, you know, the idea, I just want to mention while I bring them on, the need for a retail investor to do their own homework and either to use an advisor or to make sure the information is what it is. But you recognize Dom, you've been on with him so many times, and meet Mike Hartzman. And I'll let them take it over from here, Liz.
Oh, it's great to see you guys.
Okay.
So Liz, if you don't mind me jumping in right away, because we're short on time. So just for everybody, full disclosure, my first TV interview ever was with Liz. I don't know why in God's name they ever invited me back, but I got to sit next to you, Liz. I know I got to sit next to you for, I think, over a year, closing the market at 4 o'clock every Monday. So my greatest memories are sitting there with you and David.
Yep.
Well, one particular memory was 2008, market went through that really ugly correction crash, and me screaming at the TV camera, do not sell your valuable stocks at discounted prices. And the reason I'm bringing that memory up is I think you are really one of the pioneers of educating people out there, teaching them don't sell at the bottom, look at long-term valuations, look at long-term markets, and keep your wealth intact. I think you've done a brilliant job of helping and educating people. Have these people finally learned their lessons?
No. And in part, they haven't because, and this is part of the reason I left CNBC and came to Fox Business to help launch it. And guys like you and guys like Jordan came on and spoke regular speak versus this narrow tick by tick trade talk that helps nobody invest for the long term. That's why I jumped. Because there were times where I would say, you know what, we need to explain what a derivative is, even just a line. And it was like, no. Then you're dumbing it down for our audience. And I said, no, I don't think so. I don't think it's fair because I had to learn. And so by coming to Fox Business, that's when we realized, wait a minute, we can get people like you and Jordan and, you know, the people who speak to everyone, to doctors and lawyers and to, you know, paralegals and to people who work in the food industry and serve hamburgers. You know, the fact is everybody cares about their money. And if you're talking about the retail investor, I think this Reddit room development is fascinating and wonderful. However, back to the point of so much noise out there in the markets, I do think that it is very hard to filter through that and cut through all of the stuff you see on the internet, find out the real nuggets of what really matters. And look, I'll give a nod to Lebenthal. I mean, you guys are advisors who actually are less interested in selling product or churning somebody's account than you are helping them invest for the long term. And that's why Jordan's been doing this for decades. And Dom, you've been doing this for decades. And I don't know, I look at all of you and I think to myself, there is a very positive feel to what you do. It's not money grubbing. It's not, oh, quick, let me just, you know, and some of the biggest names in the business do it. They just churn people's accounts. I can't tell you, I had to fire my mom's money guy over one of the biggest names ever because he had her like double, tripled up and stupid stuff that was redundant. And I'm like, what? Look at these fees. Are you kidding me? And so I think that it's important that you find a financial advisor who's not incented by churning an account, who actually is highly intelligent and understands through thick and thin exactly what Dom just said. And that is, at the worst of times, not only do you hold on, you buy on sale.
You buy.
There you are.
How many times will we talk about that, Liz?
All the time.
These are buying opportunities for long-term investors. And I do want to throw it to my partner, Mike, who's a 35-year veteran in our industry, also a certified financial planner. Right up your alley, Liz. Go ahead,
Hey,
Mike.
Liz, thanks for being on tonight. I know we're short on time, so rather than asking you a question, I'm just going to follow up with what you just said. I remember in 2008, Warren Buffett was on television and they asked him, "What are you doing right now?" And he said, "I'm buying as much as I can." And when people were running out of the building, smart people like Warren Buffett were running into the building. So I think you could not have summed it up any better than that.
But don't you think it's weird, Mike, that this time around he did not do that? And I believe it's because he's not truly in charge and by his own choice of his big stock investments. He's put Ted Wexler and Todd Combs in charge, and they're highly competent. I have dealt with them on many occasions, and they've grown his cash pile. Certainly, they got him into Apple, which he normally, I don't believe, would have ever done. But look, the 13F filing just came out yesterday, and it's like, oh, well, he sold AbbVie, and he cut his stake in General Motors, and this and that. The Warren Buffett I know would not have ever exited an entire trade. He would buy a stock and he'd hold for the long term. Maybe he'd scale back a teeny bit to raise cash for something, quote, he liked better. But I know this guy, and I look and I say, that wasn't a Buffett decision. You know, and so I do think it's interesting, but I think that he's not doing what he had preached for so long, because otherwise on March 23rd of 2020, he would have been in elbow deep buying stock. Instead, he sold airline. I can't say he sold. I don't know who made that decision. He kind of took the fall for it because I interviewed him about it. And he said, well, I just, I couldn't see that far out. And I didn't really, who knows when it'll be okay to fly again. Well, just look at Delta. I mean, Delta's low was like around, I can't even remember, like $15. And now look at it. Same with some of the other airlines. They are well off those lows. And it looks like in retrospect, a great buying opportunity.
Absolutely.
They usually turn out to be, Liz. And again, I give credit to yourself and to Fox Business, honestly, that really has a passion for reporting this to the everyday investor out there and stays away. I mean, you obviously have very sophisticated people on your show, but just explain it in a way that the average person gets it, right? And I take a lot of pride that you guys keep inviting me back. I'm not sure why, but you do. And now my buddy Jordan as well. But really, thank you and the job you've done over all these years and just educating people and keeping sound philosophy, sound asset management.
Can I just say that, back to the retail investor with whom you guys deal very often, out of the blue, I have an assistant who's a millennial, and she said, why aren't you on TikTok? And I'm like, TikTok? Okay, I do Twitter barely, I use it to promote the show. And she said, no, you should be on there because that's where people my age are getting their financial advice. This was back in November when I first hired her straight out of college. And I said, I don't know how to do that. And she said, I'll put it all together for you, but you just do the content. That was late November. I now have 220,000 followers on TikTok. I do a morning market minute. All I do is just basically talk about the breaking news overnight, mostly, crypto, developing stuff that's more for that millennial crowd. And I try and explain exactly what you guys just talked about, that when it is most frightening, that means stocks are on sale. And if you wanted a TV for months and months and it went on sale, that's when you go and buy it. So isn't that what you want to do? So I'm at Red Fox Liz, and it's amazing what I have discovered now with these retail investors who are so hungry for good quality information, which is very hard to find. And they can find it with you guys. They find it with us. And, I can see my 3 p.m. Eastern show every day now is seeing ratings climbing and climbing. And I have to believe some of that is TikTok, because the younger retail investor does care about their money. They want to grow it. They want to build it. They want to preserve it, just like the rest of us do.
Right.
And
I want to bring something up here that we actually normally took a commercial break a couple of minutes ago because it's you. We killed the commercial. We ran right through it. Okay. And it's really great to have you here. And I know Mike wanted to get in with a question.
Sure.
So I'll let him do that. And I want to leave time that not only on TikTok, but now everyone talks to Liz on your podcast. And thanks for the kind words here. And when they say Liz is calling and I say, how high? When you say jump, I say how high.
I'm honored.
So Liz, I guess our last question in closing is, at a certain point, do you think 12 hours of dissecting the market is a bit of a diminishing return for the average investor?
So I don't look at it as 12 hours. I look at it as pregame, game, postgame. And I don't know about you guys, I'm a huge Cleveland Browns fan. On football Sunday, I am obsessed. Okay. I'm trying to find anything on the internet that can give me the pregame. Then, of course, I watch the game, and then I got to hear the postgame. And then the next morning, I'm on NFL TV, watching, Good Morning Football, because I have to see every part of it. And a game is a game, but money is your future, and it's your kids' college funds, and it's your retirement fund. And there is an element of seriousness to it. And what happens in the morning affects what happens at 3 p.m. And what happens overnight in Asia affects what's going to happen to your bond holdings or whatever holdings you have. And breaking news is in real time now. I mean, you see what's happening with the retail sales number, and that comes out, and suddenly the market's gyrating, and who knows about, look, I think the Afghanistan situation is a humanitarian disaster, but as the Reuters headline said, and I love this, it said, it's more headline versus bottom line when it comes to the market. So you get all of that from this real-time, information that we try to put out every single minute of the day on Fox Business. But yeah, I mean, I do think there's a saturation point. That's why I always say, yeah, it's great to see how the market opens, but what matters is how it closes. And that's where I come in at 3 p.m. Eastern.
Liz, we have about a minute left. We cannot thank you enough. We actually, as Jordan said, we blew right through the commercial break, and we just gave you the last half hour.
Thank you so much.
For me, it was great to meet you. I know you're on with two old friends, but thank you for joining us tonight.
It is my pleasure, and I so
Liz, I can't wait. Hopefully, we can do this again, and we get to see each other again. Incredibly happy to have you here, and grateful. I look forward to doing it. Thank you.
Hopefully, Liz, next to you in the studio one of these days soon.
One of these days.
That's right, because you were just on the other day, Jordan, but it was via remote, and I miss all of you guys, but I have just as much to thank you for. You've taught me a lot, and I do appreciate that.
Thank you, Liz. Have a great night, and we will
have a great evening. Thank you, Liz.
Thanks, everybody.
We'll see you soon.
You got it.
Great night. Bye-bye now.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.